Gold has always been a safe haven instrument for the longest time you can imagine. Gold's status as a safe haven asset is deeply rooted in its historical role as a store of value, a hedge against falling value of money due to liquidity glut, and a portfolio diversifier during periods of systemic stress. Under the classical gold standard, gold functioned as the anchor of global monetary systems, directly backing currencies and constraining fiscal and monetary excess since central bankers could not print more currencies and governments could not raise more debt unless they had the sufficient volume of gold to back the issuances up. Even after the collapse of the Bretton Woods system in 1971, gold retained its appeal as a non-yielding, non-sovereign asset immune to default risk. Empirically, gold has tended to perform well during periods of high inflation, e.g. 1970s oil shocks, currency debasement, e.g. post-2008 quantitative easing, and geopolitical uncertainty, e.g. Gulf War, Russia-Ukraine conflict. Its safe haven appeal is further reinforced by its low correlation with risk assets such as equities and credit, making it a core component of defensive portfolio allocation. However, gold's behavior is not purely driven by geopolitical stress. It is fundamentally a macro asset, which makes it highly sensitive to real interest rates movements, US dollar dynamics, and liquidity conditions stoked by US Treasury issuances and short-term funding conditions. This distinction is critical in understanding its recent price action. Prior to the escalation of the US-Israel-Iran conflict, gold experienced a powerful rally, with prices reaching near all-time highs in early 2026. Several structural and cyclical factors underpin this bull run. First, there was the impact of declining real yields. Gold prices are inversely correlated with real yields. As inflation remained sticky while nominal rates plateaued, real yields compressed, supporting gold demand. For context, US 10-year real yields declined from sharp 2.2% in mid-2025 to closer to 1.5% range heading into 2026. This created a favorable backdrop for non-yielding assets like gold. The second driver of the bull run was central bank gold accumulation. Central banks, particularly in emerging markets, continued to diversify reserves away from the US dollar. For context, global central bank gold purchases exceeded 1,000 tons annually in both 2023 and 2024. China, Turkey, and India were among the largest buyers. Another driver was geopolitical fragmentation. Rising US-China tensions and broader deglobalization trends increased demand for gold. Additionally, concerns around long-term USD dominance and rising US fiscal deficits also contributed to gold demand. Lastly, institutional investors increased allocations to gold as a hedge against recession risk due to the impact of high interest rates and equity market concentration, especially in US tech. This combination drove gold into a strong uptrend, setting the stage for what appeared to be a classic geopolitical breakout when the Middle East conflict intensified. The decline in gold prices since the onset of the US-Israel-Iran conflict appears counterintuitive. However, it reflects a dominant macro regime shift, where traditional safe haven instruments like gold are considered as a risk hedge during a geopolitical crisis. The most important driver has been the reversal in rate expectations. The war has triggered a sharp rise in oil prices, with markets pricing scenarios of $150–200 per barrel crude and sustained energy-driven inflation shocks. This has led to a reassessment of central bank policy trajectories. Markets are increasingly pricing a delay or even reversal of rate cuts. In some scenarios, a return to rate hikes is being considered. As a result, real yields have moved higher. The opportunity cost of holding gold has increased. This is historically one of the strongest headwinds for gold. Another reason has to do with USD strength and safe haven substitution. Contrary to expectations, safe haven flows have favored the US dollar over gold. The USD has strengthened since the onset of the conflict. FX strategists have noted that initial inflation concerns are giving way to growth fears, reinforcing USD demand. Gold typically exhibits an inverse relationship with the dollar. A stronger USD makes gold more expensive for non-US investors, and this dampens global demand. In this environment, the USD is acting as the primary liquidity safe haven, crowding out gold. Here's the golden rule grounded in macro mechanics. During falling real yields, gold outperforms USD, and during rising real yields, USD outperforms gold. Put another way, whenever the central bank is slow to raise rates during sticky inflation periods, gold outperforms. However, as the cuts come through aggressively, USD outperforms gold. Another critical factor is portfolio deleveraging and liquidity demand. In periods of market stress, investors often liquidate profitable positions to cover losses elsewhere. Gold, having rallied strongly prior to the war, becomes a source of liquidity. This dynamic is also perhaps correlated with the rising volatility across equities and credit, and the stress in private credit markets, e.g., fund withdrawal restrictions. Gold is therefore being sold not because it is unattractive, but because it is liquid and profitable. Furthermore, the current environment is characterized by a global rush for liquidity. Fund managers have increased cash allocations to the highest levels since March 2020. Short-duration instruments and money market funds are increasingly attractive given elevated yields. The follow-up question is whether the price trend is normal given historical oil crises. At first glance, gold falling during an oil shock appears anomalous. However, historical episodes suggest a more nuanced pattern. During the 1970s oil crisis, inflation was stuck at high levels, monetary policy lagged inflation, and real yields turned negative. Thus, gold surged significantly as inflation became entrenched. In the 1990 Gulf War, gold initially rose but quickly reversed as the conflict proved short-lived and oil prices stabilized. In 2008, when oil prices touched the 140s level, gold rose initially but experienced volatility as the crisis transitioned into a liquidity-driven collapse. During the acute phase of the financial crisis, gold briefly declined as investors sought cash. Thus, it is not unusual for gold to underperform during the early phase of an oil shock, particularly when inflation leads to tighter monetary policy expectations and liquidity conditions tighten. Will gold continue to fall? Gold is likely to remain under pressure if oil prices stay elevated. Markets continue to price tighter monetary policy before it is realized, USD strength persists, and liquidity demand remains high. An inflection point may emerge if growth deteriorates sharply into a recession and central banks pivot back toward easing. This is because it prompts real yields to begin to decline again, and gold could reassert its safe haven role. Another pertinent question is, could the trend outlive the war? The answer is yes. The current decline in gold is driven less by geopolitics and more by macro regime shifts, higher for longer rates, structural USD strength, and diluting diversion away from USD investments as tariff scare cools. These dynamics could persist even after the war subsides, implying that gold's weakness may outlast the geopolitical event itself. Given that the timing of the end of the war is uncertain, our portfolio positioning recommendation at this time is a long position in defensives. These include cash, US Treasuries, US dollar, Swiss franc, sovereign bonds, and inflation hedges.